Now let's first look at the Irish milk price and the butter and the skim milk powder price. And what we see there is that we have a correlation of 0.69. So you see that the milk price, the orange line, moves most of the time in sync with the butter skim milk powder price, but not always. We have a correlation. Now, if you look at, that's the data that corresponds with the exact same month, being November milk price corresponds with November butter and November skim milk powder price. If you shift that up 1 month and you say the November milk price relates to the October skim milk powder price and the October butter price, you see that your correlation already improves dramatically. I think that makes a lot of sense. Dairies tend to pay the milk price that's reflective of what's happened in the past, not what's happening in real time. And I shifted that a little bit further. If you add 2 months, you further improve your correlation. If you add 3 months, you have the best correlation of all the possibilities. Now, if I want to hedge the trend line, and again I want to repeat, the trend line is basically, I would not call it 100% the average, but somewhat of the average of what your butter skim milk powder price would be. Why do you trend that trend line? Very simple, because you have to use the futures to hedge, and the futures are skim milk powder and butter. And I compare that then with the price that was paid by the Irish dairy industry. And you see, I looked at specifically 3 periods where there is a big difference between what was paid and what the commodity price gave, and then look at what the effect would be on your milk price. So, situation 1, October 2008, let's say 6 months prior to that, you had hedged the milk price of roughly 27 euros. When the market is then coming in at October, and we look at the butter price and we look at the skim price, you see that those 2 components would result in a settlement price of a market price of almost 25. But the dairy paid you, and I'll go see if I can go back, the dairy paid you a much higher price. Now what is the result? You win twice. You get more money than what the market pays from your dairy, plus you get money from the exchange. So that's almost a fantastic scenario. You get a milk price of 36 if you had hedged, although your objective when you hedged was only to have 27. But as you can imagine, that's the best case scenario, or well, I don't know if you can call it best, but that's a scenario where you get a better result out of hedging than what you had as a target. But it can also go the other way around, and that's a situation that occurred in May 2010. And in June 2013, we have a little bit of a mixed bag, but nonetheless a situation where you had a worse price than what your target was. And so if you look at that on a consistent basis, you see the trend line, you see the orange line, that would be the milk price that you receive if you did no hedging whatsoever. Well, with a poorly correlated milk price, meaning a milk price that is not very well correlated to the commodity price, and you would hedge those commodities, well, the result is probably as volatile as the situation when you wouldn't have hedged. So this is a very good example that if the milk price doesn't follow very nicely mathematically the underlying commodity prices, then hedging doesn't give you a solution to tackle volatility. And I've now did that with series that have better correlation, and what you will see is that as the correlation improves, the volatility of the milk price that you achieve, that you realize by hedging, becomes less volatile. You see already 1 month shift in the butter and skim milk powder prices, a higher correlation, a better result. If you go even further, you see that the volatility, while it is still there, it improves. And this is, yeah. And this is then the situation whereby you had the highest correlation, meaning there was a 3-month difference between the price of butter skim milk powder and your hedged milk price. Now I looked at cheddar because, of course, in Ireland cheese is very important component of your milk price. You already see that with cheddar I have a better correlation than with skim milk powder and butter, 0.84. And if I shift 1 month, I improve it slightly, but not significantly, just a little bit. But the cheddar price of the previous month is, in this series, the best indicator of your milk price. If I go then further 2 months and 3 months, that correlation then goes down again. And if I do again the same situation, here the red line is the Irish milk price paid, the blue line is the target, and the green line is the price that you would have realized if you would have hedged the target consistently. And you see with cheddar, you are getting already much closer to that blue line than with skim milk powder and butter because of the better correlation. This is with 1 month delay. Again, you see a fairly good correlation. Now you could argue that is still not perfect. I would like, if I want to hedge, I would like to be much closer to my objective than I are today. Those are the ones with more delays. And finally, what I did is I looked at a combination of skim milk powder, butter, and cheddar. And if you use 70% cheddar and 30% skim milk powder butter, each with a different delay, with the best correlation, I was able to improve my correlation. So just as an indication, with skim milk powder butter, I had a correlation of 0.8. With cheddar, the best correlation was 0.84. But if I mix them, surprisingly, the correlation improves. You get a higher correlation than the correlation of the individual series. And the highest I achieved was 0.88. And if you apply that mix to your hedging strategy, you see the result, the green line compared to the orange line being the actual milk price. You have been able to reduce, to a large extent, the volatility of your income. I leave it up to the individual appreciation, whether that's sufficient or not. But the bottom line is, the closer that the milk price that's being paid to you is related to the commodities, the closer you will get to a scenario where your hedge result, basically the ultimate income, the combination of what the dairy pays you and what you receive or have to pay to the exchange where you have your futures, the closer it will get to that blue line. I think that's very evident about this analysis. I did a study whereby I said, let's say that the dairy offers to its farmers 20% of the milk at a flat price following the trend line itself and 80% following the commodity. Well, it goes without saying that by doing that, you have a better result because your volatility is reduced from 100 to 80%. So in the actual presentation, I had taken that out because I think scientifically that is probably not the best approach. But here you see in such a scenario, you could have an even better performance than in a scenario where you only have a milk price based on commodities. Now I just wanted to compare the Irish milk price with some of the other important milk prices. And first, this is the series where we compare Ireland, France, UK, Germany with the butter skim milk powder price. And what we see is that surprisingly maybe Germany, or maybe not, Germany gives the best correlation for that combination. And in France, the correlation is extremely poor, only 0.25. If we look at cheddar, then we have a different scenario. There it's the UK milk price that is best correlated to the cheddar price. Somebody asked me during the welcoming coffee session, does that make sense? Because in the UK 50% is into the liquid milk, the milk goes into the liquid milk market. But these are the numbers that suggest that in the UK, the milk price paid to the farmer is best correlated to the cheddar price. I was also surprised to see a very good correlation in Germany, which is not really a cheddar market, but one could argue that the Gouda market and the cheddar market are probably fairly correlated in itself, and hence that you see in Germany a good correlation with cheddar. And if you then look at the mix, what we see there is that Germany, the combination cheddar and skim milk powder butter gives the highest correlation. And so that means that basically in the model, in Germany, if they would apply a milk price based on that model, they have the best possible results from a hedging strategy because the correlation in Germany is the highest. Now, what are the conclusions of this work? Well, it's very important that if you want to use futures as a tool to eliminate the price volatility out of the market, it is very important that the milk price paid follows the same logic of the commodities, meaning there is a very clear relation between milk price and between the commodities. Now there can be 1 month or 2 month delay between the commodity and the actual paid milk price, but if you want to establish a strategy to offer the possibility to generate a milk price that is stable without a commodity-based milk price model, you have poor results. There is, of course, a weak spot in this whole debate, is that today in Europe there is no cheese future, there is no cheddar future. The only market today that is offering cheddar futures is the US market, but you can ask yourself if the US market is offering a good correlation with our cheddar market. And I had a graph. I'll go over the following slides. Let me see if this is the one. No. Voila, here you are, because this is the slide I wanted to show. This is the reported cheddar price in Europe, US, and Oceania. And I think it's put Australia, New Zealand. And what you see there is today, we say that they are correlated, but I would tend to argue that there is, especially in 2013, that there has been more diversion than conversion in the cheddar price. So you can argue yourself, if you would use US cheddar futures to hedge part of your milk price, would that give you a good result? So maybe this, if there is this study or this analysis demonstrate that maybe in Europe there could be benefit to add on top of what you have today at Eurex, the skim milk powder, the butter, and the whey future, maybe to also introduce a cheese future. The only question that you have there is, should it be cheddar? Should it be Gouda? What is the most relevant cheese product that could determine that future? But once again, if we look at the German situation, in Germany we had a fairly good relation with cheddar, so why not generate a European cheddar future? Now I must apologize now because this is the first presentation that I made. Can I maybe just quickly go to the other one? Yeah. If I can. Is it? How do I do this? Ensure. Should I get it on my stick? No? This is my stick. I don't. That's my bucket. Because otherwise I can finish. I think. Right? Yeah. Did you get the stick? No, but did he? No, that's mine. I have my stick in my. Okay. It's in your. Let's see if I can get that. To show you, I was so proud about my gimmick here, but one of the elements that I wanted to show, if you look at a glass of milk, then you can also look at it at the individual components. You know, milk fat. You have two types of protein, soluble, insoluble. The insoluble is the casein, and the soluble is the whey. You have lactose and you have minerals. Why did I make that presentation back at the expert group for agricultural commodities, and I had an audience that was not so knowledgeable on milk, but I thought it was a very good way to demonstrate why commodities can determine the milk price. Because what happened basically, if you want to make butter, you move, and you want to make skim milk powder, you move those solids with a little bit of water to the respective groups, and hence you can see that with butter and with skim milk powder you can calculate a milk price. And something similar happens for cheese and for whey powder. So that's didactic. I'm now going to show you this one that's in that slide. When I explained to you that futures evolve towards a trend line, this is an example from futures in the US at present. And what we're seeing is the market is today at a certain level, and you see it very well, for instance here. Market is at a certain level which is higher than the long-term average or higher than the trend line. So what you see is that the futures prices over time, and here it takes about from July, August 2014 onwards, we move towards a more, here it's a flat area. The class 4 milk, which follows skim milk powder and butter, also does that. So that's the basic principle. If today, and this is the case, November 2013, you want to hedge April 2014, well, it's very likely that the price that the future offers you is a price that is close to the trend line. That was the whole basic principle in my presentation. Is that if you want to know ahead of time what you're doing, so if you can hedge this trend line on a consistent basis, that's what you try to achieve. And in order to achieve that, you need a milk price paid by the co-op or model that follows those commodities very closely. And I'm just going to finish now with my conclusions. So here are my conclusions. So it's very clear that even today, we saw about the correlation, that cheddar, butter and skim milk powder have a very important impact on the milk price paid in Ireland. Now, if you want to use the tools that are available to deal with that risk, today at Eurex you only have butter and skim milk powder that are being traded. And this is then the graph on the cheddar price. You can ask yourself if the US cheddar future is a good alternative or a good option to complement that part of your milk price. But, and that's then the final conclusion, and I will then leave it for questions. I think what is very important, I'm repeating myself, the good correlation, and what is very important, that whether you're a farmer or you are a co-op and you want to develop a hedging strategy in order to be able to offer to your members stable prices in the future, it's very important that you start from a situation whereby you sell everything as if you sold everything on the spot market. And from that situation, if then you create your milk price model, because we know the reality is different. Today you might find it attractive to already forward sell for a whole year at the current high prices. If you take all that into consideration, you create a milk price model that doesn't give you a good instrument for hedging. But, and that's then the beauty of it, if you have a milk price model that takes care of the spot market, and then you're allowed to use it to hedge in the future, it gives you also opportunity to take advantage of favorable market conditions. If the price is high and you can forward sell for a longer period at a price that's better than the trend line, it gives you the opportunity to do better than the trend line and to, as a result of that, to create more value than just following the market. What is also very important is that in order to be able to realize such a strategy, you need a lot of liquidity. That means you need a lot of participants that are interested to buy and to sell those future contracts. We hear a lot today that people say, look, futures, that's interesting, but I'm going to start trading futures when liquidity is sufficient. But everybody is having that same approach, and as a result, liquidity is not increasing. Now, what is very important in that whole debate is that you want to have large participation, because in a scenario where everybody says that's if the price is high, sellers want to sell, buyers don't want to buy. If the price is low, buyers want to buy, sellers don't want to sell. So if you have participation also from third parties like traders, that gives the possibility to create a much more volatility. And I know that a lot of times you hear that in debates, there is excessive speculation. Well, let me tell you something, excessive speculation, that is a myth, and it's certainly a myth in the dairy sector, because we've seen volatility over the last couple of years without an active futures market, without banks or financial parties being part in the trade, and despite that absence, we've seen the volatility. So in the expert group from the Commission, there have been a lot of presentations by academics trying to demonstrate the impact of speculation on volatility, and they all come to the same basic conclusion: there is no relation there. This is a myth. It's a nice myth to present, but it's not substantiated. Similar to the person that spoke first, there's a lot of myths about the relationship between food and health. There's a lot of myths about how damaging dairy would be. I think excessive speculation falls under that same category. What is also very important is that the contract size and the specifications of the futures contract must be suitable for the market, meaning the specifications must be really representative of what is being actively traded in the physical market, and the size of the contract must be suitable so that people that also have to trade smaller volumes can take advantage of these contracts. And last but not least, what is very important is that the settlement mechanism, so if you have a butter future, at the end of its contract period, it expires, it settles against a reference, but everybody must be comfortable with that reference, because if that's not the case, also there you will not have the liquidity. Well, I'll stop here because I think I've done much more than my 30 minutes, and I'll leave you for questions now.
Thank you very much. Thank you very much.